Welcome to FT World. The UK is on the edge of deflation, with price pressures hitting zero in February and most forecasters predicting inflation to turn negative in the coming months. Should we be worried? And what's the Bank of England going to do about this? Discussing this with me today is Clarke, Chief UK Economist at Scotiabank. Thank you for being with us today, Alan. So let's have a look at the first chart which you brought with you today. And this is really telling us what's happening behind that headline inflation number which hit zero in February.
Sure. A lot of the things that are going on pushing inflation down at the moment are lower energy and lower food prices. That's pushed headline inflation, as you say, to zero. The next few months, it probably has a little bit further to fall as you get components such as airfares, which naturally take a little bit longer for the fall in oil prices to percolate through. But it gets interesting towards the end of this year, where second round effects come into play. And that's what the chart's intended to show. So in the past, normal thinking is it's cheaper to fill up the car with petrol, it's cheaper to buy food, you've got more disposable income left to spend. And typically UK consumers will spend it. We've seen it pushing up retail sales, and that should ultimately push core inflation up. And that's what this is intended to show. It's very evident in the late 90s when food and energy inflation here is going up. That's a squeeze and it pushes core inflation down. You get the reverse here. Food and energy comes down, core inflation goes up, and it roughly echoes it over the period. Breaks down during the crisis because you got VAT hikes and cuts, university tuition fees went up, but largely speaking that relationship has held. So what I would expect is come towards the end of the year you'll get a double whammy of positive second round effects. This feel-good factor, more spare cash pushes up core, and you'll also get energy base effects because the drops in energy we've seen around the end of last year, start of this, start to reverse and push up on inflation.
Now let's have a look at energy, which is really the second chart you brought with you. So we see a really big drop over the last few years. I mean, over the last few months, we hadn't seen anything like that since the financial crisis, really.
Exactly, and the financial crisis gives us some clues as to what we could expect. And my point here would be a small increase in the level of oil and the level of petrol can go a long way. If we look at what happened in 2008, 2009, when oil fell, it fell from $140 a barrel to 30-ish. And then it rose only a small amount to about 50, far less than it had fallen. Yet look at this, year-on-year motor fuel inflation. It went from about 25% year-on-year down to -15 and all the way back up to +25, despite the level of oil only increasing by a smaller amount. Now the best way to understand this is think about percentages. If oil had gone from 100 to 50, that's a 50% fall. If it goes to 50 to 100, that's a 100% increase. Now chain linking elsewhere in the RPI and CPI basket takes care of that, but not for petrol. Hence my point, a small increase in petrol goes a long way. So we've fallen a lot. Petrol doesn't have to go up an awful lot to add. So Martin Will from the Bank of England made a great analogy. Inflation's like waiting for a double-decker bus. You wait all day and then three come along. On the downside, we've had a triple whammy of lower food, lower energy and some lower core. On the way up, it may well be the same. You get a pickup in energy, amplified because of this quirk. Something else may come along.
So how should the Bank of England deal with these double-decker buses, which may all come at the same time? Let's have a look at the third chart, your final chart. So inflation is well below target, and yet we're thinking about hiking interest rates.
Well, we've been 6 years without an interest rate hike. We'll probably make it to 7. I don't think they'll raise interest rates until 2016. These fears of deflation are probably delaying hikes further. I don't think we'll get a cut. But I think they'll raise interest rates gradually in 2016. Now, this is a really key thing for investors in the inflation-linked bond market because the RPI index, which is what people trade on, includes mortgage rates. So ironically, if you raise interest rates, that measure of inflation goes up and that will push RPI inflation up. Presumably, the Bank of England's hiking because underlying inflation pressures are picking up. So it could be a really good year for inflation-linked gilts as we get into 2016.
Well, thank you very much, Alan, for being with us today. So in spite of inflation hitting zero, the real worry is how fast it will rise, perhaps. That's something the Bank of England will need to think about.